Topic. Welcome, everybody. How's everybody
Well,
doing?
Peachy, how about you?
Good. I'm doing good.
Joe?
What's up, guys?
Hey, Jesus. This fucking camera. Okay. All right. I'm in the show. I'm ready to go. Kevin.
You look
What
good.
kind of camera is it, Julian?
It's
Why
a
do you dislike
it's
it?
an opal. It's an opal. You know,
You
it's
look
an opal.
good. You look good.
Thank you, Kevin. I'm trying.
I always get you with you look good, and then you'll keep on trying it.
That's it. I just need a little bit of encouragement. What's on your mind? What's on your mind, Kevin?
What's on my mind right now? We were going back and forth with this in the group chat that we had, but it was around YC. So, Gary Tan. Let me just pull up the president. Yeah, the president, or what is he? The CEO of YC. What is his title? President and CEO of YC. So the YC demo days just happened, and we're in the kind of the market we're in right now. Is kind of weird. We have so SVB collapsed, got bought out. There's not a lot of investment to go around to later stage companies. YC obviously continues to go on, and I was trying to find his tweet here. Basically, he said that it doesn't. Yeah, oh, here it is. Founders comparing early stage round valuations is like comparing the color of shoes at the beginning of a marathon. So, the reason I thought that was interesting is that like we're going through this like insane like right now like Series B and C or even A, like this huge valuation reset. And then you have Gary Tan coming out and saying it doesn't matter what these early stage round valuations are. And it just seems like, especially in this environment, I understand like these are, so probably what is happening is that people starting companies, right? Like they're earlier on. And so there still is a lot of capital for seed stage companies with the hopes that eventually like these companies will IPO in 10 years and the market will be better and all those different things. So I could definitely see how you can why there's a lot of capital going into seed, why people are more bullish on putting money there, why Gary Tan thinks that valuations don't really matter. But like what we're seeing right now is like they do fucking matter. Like there are companies getting crushed right now, going out of business because they took too much capital, they took too high valuations, and when the times were good and there was a lot of companies going public, their market caps are getting crushed. So I thought it was just really interesting, and I love YC for so many of the things that they do, but this is the one thing that I hate that they do. And I don't know if it is because they're looking to get a markup on their companies. But going through, I've never been through YC, so I definitely can't speak from my experience there. But it's like they really, what I've heard is like they try to like beat into like get as much money at its as high valuation as you can.
You're literally, you're going to create so much hate with this podcast. Okay. So, and
I just I don't agree with that. I think it's a silly strategy to do that. And you're seeing what happens when companies do that now.
I was just recently on a thing with First Round Capital where they talk about, talk to only early stage funds, or early stage companies. I got in through one of my investors, and they're talking a little bit about the stuff that they've seen. And one of them is like, if you raised in 2021 or 2022, just have your valuation, just straight up cut it in half. It doesn't matter. Everyone is already cutting it in half in the first place. So you might as well do that because nobody respects this valuation. Nobody thinks that it's real. And so I will say, again, it's funny. I was imagining you have these scenarios in your mind. You're like, would I go into YC now? And I still don't know the answer. I think I might, even today, thinking about it, not with this business, but if I ever start another business, maybe I would. But the I don't know today whether the valuations are there. Everyone knows that they're imaginary, and I think YC comes from a place of, if it's not working, fuck it and abandon it. Which actually, like, unless you really believe in it, and at which point respect and continue to do the thing. But it's more almost like startup ideas are worthless if they're not going anywhere, and just abandon them. Andy?
Julian, kind of on the imaginary side of that everything is imaginary at the early stage. Obviously, it's a little bit different when you start crossing 30, 40, $50 million pre-money valuation. But do you
So
think you're
that's what's happening.
That I mean, I know we know that's what's happening, but it's because of this fucked up time where everyone was just throwing. I mean, you remember what it was like doing these fundraisings. For those of us, if you're listening and feel like you're part of this group, and good on you, because like it's not a lot of people, I think. They were just like, yeah, fuck it, let's do another round. We've had like a modicum of traction. Let's execute and bring $15 million in. Like, that was just happening 18 months ago. It was crazy.
Which is the worst advice ever for a pre-product market fit company. There was also, I think that, from another one of the, I can't remember what his title was, but from YC, he actually just put a tweet. It was basically like the biggest reason startups fail, is, well, for one, I think the number one is like the you just can't build a product that people like at all. Or you break up as founders or something like that. But in there was like, you rescale a company that has not found product market fit.
Yeah.
You hire a bunch of engineers, you get over your skis, and that's exactly what you're going to do with, if you raise a $15 million seed round, that is what you are going to do.
Yeah, the expectations are so high.
I think the expectations are very high, but certain idea we're all approaching this from marketplace, generic B2B,
Sure.
B2C. Certain ideas require 15, 20, 30, 40, $50 million of capital. If you go talk to a healthcare founder, they're going to need 100, if you're a biotech guy, you're going to need 175 to
Sure.
$200 million to approve a drug. Would you rather take $200 million today, and you're still a coin toss odds at best, are you going to be successful? And you're going to spend 10 years of your life, or would you rather constantly fundraise? So, I mean, this generic advice that you need to raise $2 million on a PowerPoint at a pre-seed of X, and then you need to go raise a seed, and then you need to go raise an A, it applies to some companies, but it doesn't apply to others. And so I guess I see Kevin's point of don't raise more than you need. I mean, the reality is don't scale too fast. I'd much rather have more money and more time and more capital if I could if you can mentally take it, knowing that you're on a 3 to 5 year journey.
I mean, it's not just like fucking, it's just like, isn't every round just get whatever the fuck you can, or whatever terms you can, and try to survive?
No.
Yes.
I mean, Julian, I'm with you on this one, man.
Just try to survive. That's what we're all just trying to do here. The last company I ran, it was, oh, fuck, how much runway do we have? I don't know. This like thing of milestones-based fundraising is new to me. I was on a treadmill every 18 months. I was raising because I had to, and because I was in a high burn business. And so, like, it was just like, well, let's see what we can get out there. Oh, fuck. And it just kind of kept working. Joe, you raised a lot of money. You tell us, you feel like you're the old wise man here, I think.
Definitely the old one. I don't know about the wise one. I think this conversation about companies raising too much at seed today, 18 months ago applied to everyone. Today applies to like a small subset of YC companies doing AI stuff. And they'll figure their stuff out one way or another. And that may be one of those industries where having the runway to do whatever winner take all things you need to do is critical. Time will tell. Most people right now, most early stage companies and even kind of mid stage are in this world of like, can I just like not do a down round?
Right.
Can I get enough runway to make meaningful progress so I can do another round in X number of months? I think that is the reality. I don't think most people need to be told in this moment not to raise too much at too high of a valuation. Everyone's just trying to get a deal done.
Mhm.
And the like subset of YC AI companies, that exist in their own bubble will figure their own shit out.
I think also most of those AI companies have costs. They have training costs. They have compute costs.
yeah.
They have GPU costs, depending on what facet of AI you're doing. I mean, there's a reason you see some of these companies raising in the AI space $150 to $400 million of capital. They need that to power a transformer model if they're going to build from scratch. And so it literally is just, this is the requirement of even to play baseball. The team this is what it costs to staff the team.
Yeah, that's a fair point.
That's your payroll.
If the costs have changed for some of these, I think this is like a subset. But like going back to, and I feel like a broken record, especially on our WhatsApp group. Like, and let's just talk from experience. Like I've seen from the other side of it. Like, so at my last company, we raised prior to product market fit. We raised way too much money.
I just think you have trauma. I think
I think so too.
Here's a list of all of the. So let's remove the biotech companies and everything. Let's talk about like YC's like bread and butter, which is like software companies. Here's a list of some of their biggest outcomes and their initial seed rounds. Stripe, 2 million. Instacart, 2.3 million. OpenSea, 2 million. Dropbox, 1.2 million. Airbnb, 600K. I do believe that constraints breed creativity. And while it's very uncomfortable to go through those times with a smaller team, not enough resources, I'd also argue that today, if you're not in AI and you don't require a lot of like costs for all these GPU cycles and all those things, like you're much more, you can be much more efficient with like all the tools. So it actually should be cheaper to build startup. So like before you do hit product market fit, your goal should be to get there. And I just think that raising littler amount of money, having a smaller team and just focus on getting that and then take more capital. I'm all for, like, we're all in the venture capital, kind of treadmill, and like as soon as you hit product market fit, I am all for go raise as much capital. You need to be the industry leader. That's what this whole business is all about. But before, I just think that it just makes you sloppy. People, you have the money in the bank. You're going to hire these senior people. They're not going to be as scrappy. I'll just talk from my experience.
Okay.
Like I've seen that. So that's what I'm kind of coming from. But of course there's exceptions.
Kevin, I think you're right. It's true. It does make you sloppy. I remember being sloppy. Of course, currently I'm not sloppy at all. But back then I was absolutely sloppy. What do you tell the people that over-raised a little bit? They're sitting on a valuation that they don't deserve, that needs to be cut in half. And so what would you do if this is not your situation, but what would you do? What hard decisions would you make? What would you advise others if you had invested in their company and they were listening, which they don't?
So I think it depends on the stage of the company. So one of my friends actually was looking at joining a company that raised at one of these like insane multiples, like it was like 500x. And the founder was not willing to come to terms that was not their real valuation. And he's looking at the actual, like the stock options he's going to get. He's like, these are already underwater. He's like, I'm not going to join your company. So I think that if you are in that position, not even if you've raised a lot of money, be disciplined, try not to overhire, even though it's going to be hard, do all those things. But I think also to attract talent, you need to reprice yourself, because people are joining for the equity upside a lot of times. So do that proactively. Take that hit.
You would actively take a down round.
No, I think you would try to actually reprice the company. And I'm sure there's a lot. Andy could probably, as the VC in the room, talk about a lot of those things. But like, how do you, in this circumstance, so a later stage company, so say in this case it was a Series B company, they raised at like a 500x on like a few $1 million in revenue. Like, what would you do to attract really good talent?
Yeah, I mean, I've never seen this actual scenario play out. I was a VC. I'm not a VC. So I think the scenario I've seen, I think what you're describing is proactively restructure the company. And I've never seen it. I don't know. I think that company that Sequoia did, Vise AI, it looked like there was a blog post where they actually went and did this. I'm not sure if that was the exact scenario, but it's something along the lines of how they reprice their equity. And so maybe this is that scenario. I think you do probably have to do something like that. I think the simple solution is grow or die. You either have to grow into that valuation. And that means you have to hit the numbers that you told everyone you were going to hit when you raised at 500 times revenue, or you have to do something drastic. And what that drastic thing means, it could be pivoting, it could be restructuring, but I just think some of these high revenue multiple companies, you're probably in trouble.
Yeah.
And I do think, taking it full circle back to what Kevin said, I think, Kevin, you're probably the only one here who's really raised a lot of money pre-product market fit and tried to do the scaling. And so maybe some of your advice does come from some of the trauma. I don't think Joe, myself, or Julian have ever done that. I was always on the hamster
we all have
wheel.
real companies. Yeah, that's not a big deal.
We were all more capital constrained. You're better at playing the hype cycle than the rest of us. Let's do it like that. And I think we had a really interesting guest on this show, Siki Chen. And I think Siki talked about his runway. I think he had 5 years of runway in the bank. They don't have a lot of employees over there. They had maybe sub 20, and don't quote me on this. I think we're going to have to go back to the interview. And he's just playing the long game. He knows he has to find product market fit. He is not hiring a bunch of people or increasing burn. And he is focused on it. And he has 5 years of runway to figure it out. That's a very interesting way to run a company, but that's one way.
Yeah.
And
I appreciate that restraint.
Works.
I respect that restraint a lot. It is so, I mean, like I said, Kevin, you and I grew up in the same space where it was like, fucking hire, just do it. That's how you scale in 2013 to 2016 or whatever. Joe, you raised your Series A was a massive at the time, 1.5 million or whatever happened in 2009. You can't do that. Can you do this in 2023? That's the real question, I guess, because my first employee is a breather. They all made 85K, including myself, right? Those people don't make 85K anymore in this day and age. And also you've ran a pure software business that you started and that you wrote the code for the first time. The average founder is not out there writing code the same way. They're more like a hype machine marketing person or something. So like, are those conditions even possible for most founders or no?
Yeah, it doesn't feel like it. I mean, certainly that is it's so awesome to be young and just to be able to just like, have a way lower living expense and be skilled in a way that you can do those things. Like, for me and most of my network, I feel like those days are past and, you be scrappy where you can, but the world has changed. It's also changed in the sense that it is so much harder now to get attention and make anyone care about what you've built.
Yeah.
Like the first version of Klout was so shitty, like unspeakably shitty. And people jumped all over it because there wasn't 500 other things, 500,000 other things, 5 million other things like competing for attention.
Yep.
And I'm feeling this now in what I am building. the bar is so high. Table stakes, are like so set in place that to get anyone to try what you're doing and if you're trying to get somebody to switch off something to what you're doing, like you really have to deliver a very, very compelling.
Mhm.
Joe, I don't mind telling you, the first 3.5, 4 people at practice here, those people started out building a chat product that was a consumer focused product, right? And I used to talk to people about it being kind of a teaching thing, a peer-to-peer learning and teaching thing. And it was just iOS. And I want to say, did it take 12 months? We didn't have a lot of money. We clearly didn't have a lot of burn for 4 people. I was like, we don't have the team to do this. This is not our DNA. The bar for chat is so high. Consumer, you're in the right town for it,
Yeah.
if a town exists, which is Los Angeles. But the consumer bar is so high. You were chatting the other day in the WhatsApp about the location, like when do you get people to accept notifications? Like, I
Correct.
don't know if I could live that way, my man. I don't know if it's possible. It's tough. All small deal things are tough. I do an average $35 transaction. That's tough because I just got to get the crazy volume. You have to get $0 transaction. It's kind of almost harder.
Yeah, we need time. We want people's time and attention. And there's a lot of competition for it.
No doubt about
I think
it.
And we're not necessarily solving a specific pain point that you're willing to throw money at and you're compelled to like solve. We're trying to like I don't know, inspire you to do something you weren't necessarily imagining you were going to do.
Joe,
Mhm.
Joe, just for the audience, can you just explain like I know you're not public with your company, but like what your business model would be?
Yeah. So, I mean, we're, it's not necessarily a secret. We're just early and there's not something worth showing everybody yet. We're building basically a new professional network. And so it's, a pure consumer social networky type thing.
And by the way, you're the most qualified person, like among the most qualified people that I know. And it's still incredibly hard. And that is what's challenging. You would feel I knew how to build a company in 2013 to 2015, right? Like I
Mhm.
built a pretty sizable, successful thing with positive unit economics by the end. But does that help me in 2021, 23? It does. It helps me hire. It helps me lead. I know how to lead people better. I know how to manage better, and I know how to, how to direct people. I know how to make better decisions. But does that mean I have everything figured out? Certainly not. Even if I ran a real estate product again, I would still not have figured everything out. And that's the part that's really challenging is every single part at the time you do it, it is faster than the last set of fuck ups that you made.
Right.
And you do it 10% more correctly or 20% or maybe even 50% more correctly, but certainly not 100% more correctly.
I got a question for everybody listening. So like, I know that we've all internally talked about like our burns and all that. Obviously we won't disclose any of that and like when people need to fundraise and everything. But for the people that are in like a decent runway position, like how much does this impact them? So for all the listeners, like as far as like the market, it's really hard to raise a series A or B, but like how much does that actually impact? How much should they be paying attention to that?
Yeah.
Versus just like being heads down and just building, because for like this can be very distracting. Especially if you have like that 24 months of runway and you're a seed stage company and you're trying to find product market fit, you're like, should we be cutting and all this crazy stuff? Like what is your advice to anybody else listening as far as how much should they be paying attention to kind of this news cycle right now?
I just, having just been in this first round capital thing where they're explicitly asked me not to share, and so I'll be minimal with the amount of stuff that I share, but it fits my framework. Do you have to raise in the next 9 months? Yes or no? If yes, what are my odds of success? High, go do it right away. If it's low, then it's like, do you have the ability to solve those fundamentals in 90 days? Can you do it in 90 days? Yes or no? If you can do it in 90 days, then go out, roll the dice. If you can't do it in 90 days, your options are cut, burn, raise a top off, or Hail Mary, which is to be like, fuck it. I know that I don't know if y'all have done rounds like that before. I definitely have. I have.
Yeah.
Most of my life, I feel like those are the rounds. I have over a year of runway today. So I have the opportunity to sit and execute some more.
But for everybody
I like
else,
Hail Mary as an option. I'd love to know what that actually looks.
Well, you know what it looks like? It's like get
no,
150 fund names together and do them serially and back channel and like all that crap that you do when your back is against the wall.
So let's give some actual advice, right? I think that our last episode we had Michael Cho from Unsplash on. I think he actually gave great advice as far as like what did a Hail Mary look like. So they were in a very unusual spot that they had a side project that took off Unsplash that they weren't making any money off of, but it had hundreds of millions of monthly active users on it, and they just couldn't raise more money. They had a big pref stack, and it was a different environment. But his thing was just like reach out to a ton more people.
Yeah,
he's like
and unusual financing sources.
Yeah,
I've definitely done that. Like try to fill out a round in my history. It's like rando Asian like pension funds.
Sure.
And we all know that they exist. We have some contacts and thank you for your commitment. You know, if any of you are listening, you funds. And also, you know, I would be remiss, the Canadian pension funds, you know, every Canadian knows that they can go talk to them. And the real estate funds that are run by some, you know, multi-family office or something, right? And so there was, in my space, and that's one of the reasons Adam Newman was so successful fundraising at WeWork, is there was an infinite number of these rando financing sources.
Right.
He would just fly to Abu Dhabi or some shit, and then it'd be $100 million in oil money or something in his company. And everyone was like, I've never met anyone like this. Wrong accent. But that's what he did, and it was successful. Running straight software is harder, but it's certainly doable. Michael talks about doing it. You know, it ain't easy, but you got to get super creative. You do.
We've all, at least I can speak to myself. I've definitely done this, Julian. So I've definitely done this along the way.
I'm just laughing about the feeling of like, who the fuck could we talk to? Oh my God, who are we going to talk to now? Shit. Looking around the table.
Done this in the last decade.
Well, and sometimes there's also, it could be somebody in the industry. Like, so I think that, so for people in a tough spot, you're going to, first of all, you're going to look to your existing investors and to see what you can kind of pull from them. But then there's like a whole, like there's a very large community out there of people who know other people who know other funds, all of that. I think that's where I would like, I've sourced more capital doing that way. And it could just take one person that leads to another intro to whatever. And so I think like the advice that I would give people is like, just don't give up. If you actually have something that's working, don't give up and just continue trying. Reach out to, I've done this before in previous rounds. Even with Airhouse, we had a couple of rounds that were kind of hard to get done because we had an early marketplace with no revenue. That's completely changed today, which is great. But like, I would just reach out and be that one person who introduced me to this one other firm that it's like, oh my God, we just got $1 million in the door. And then that starts a whole new round. And it just like, this is the whole story with Michael. He just reached out to this one person he thought he was going to angel invest. And then they ended up doing a $5 million investment and completely restructuring the entire cap table to get later on Jeff Lewis from Bedrock to invest in them. and then they were able to sell. So it really is, if you have a really great company, it's just like, don't fucking give up. Like
The
keep on
part
going.
that I like about this podcast, by the way, is that we're not focused on, and this was a big exit, right? We do have those people as guests,
Sure.
and we did have those outcomes, right? Like Loom at the moment, that's a top company right now, right? Figma, like all these other companies like Plaid, those people, those are top shelf and VC based companies. And Michael, thinking about it, I don't actually know what the outcome is.
I don't know either.
But from a VC standpoint, I don't care. What I care about is the entrepreneur that got to the other side. And that's the thing that I respect the most, not to be generic, but the man in the arena, the man or woman in the arena that is doing the work every day. And it's the part of the Paul Graham thing that I respect the most, because he's got those 13 sentences about startups that I always return to, like the 100 theses of, what is it, Martin Luther or whatever on the wall. And the two that I always stand by are, don't get demoralized. And then if you do get demoralized, don't give up. And that gets you through a hard quarter if you have one, to me.
Until you've got a no from at least 3 different Japanese corporations and the Rotary Club of Tokyo, don't give up.
Don't give up. Yeah. In my case, it was talking to Singaporean private equity funds, real estate funds, and Canadian pension funds. And, it's just, I didn't even know any tier 1 VCs. I was just looking back because I was sharing something, and I was surprised by how few tier 1 people I spoke to at my last company.
Right.
I still got something done. Joe, you have a thought?
Yeah, I mean, this whole conversation of these Hail Marys and these overlooked investors and things like that, it just, to me, brings to mind how lucky you have to get in the startup stuff. Like, we all work, as hard as we possibly can. And that work puts you in a position to get lucky, but it is the random intro, the random, foreign government, the random, meeting that turns into an acquisition offer, whatever, that is the difference between an amazing exit and maybe just nothing. And, I've seen both sides of that. It's funny how often that comes up.
It is. And the one that I sit with all the time is the Evernote story of they're planning to shut down their company, and they're 1 week away from missing payroll or something. And they're chatting with their users. Evernote, again, the outcome is not material to me for the part of the story. And they're just texting with these users at Evernote. And one of them is I just love this product. Can I put in money? And they're oh my God, sure. How much? And they're $500,000. And that random user saves the company by investing in it 1 week before payroll is about to shut the thing down. We've all had moments like that. We talked about them. I'll never forget Dave Moran being I love your product and I want to put in $1 million when I really needed it. So it really does speak to, we're not immune to the cycle here. Also, we're going through the cycle. There's a reason I was in that first round capital thing, because I want to know more about what it takes to raise an A in this market. So we're not immune to it. I think one of the things around the table that we understand that maybe other people do not is you kind of just have to keep going, even though you don't know the answer.
Yeah.
My superpower is walking on glass.
Well, and this kind of goes back to, I think it was Paul Graham as well. It is the whole thing is just just don't die.
Yeah.
Right. There's a lot of things that could change. It could be in the market that you're in with your customers. It could be in the VC market that could change. It could be a macro thing that could change, right? Look at what happened to COVID. There's so many COVID success stories that happened over that. And it was just just don't die. Do everything possible you can to just not die. And then there can be some amazing stuff. But like, yeah, I'm sure everybody on here has been like, even myself, at Shyp, like we raised a lot of money, and we still in between rounds, it was like, we're like almost out of, we're like, can we make payroll? Like as we're closing these rounds, like, I think can everybody agree on here? Like that we've all been through that.
I've definitely felt that pressure. I remember waking up and waking up in the middle of the night and sitting on one of my old couches that I had at like 3 o'clock in the morning. And I open up my laptop and I'm like looking in the early stage. It's like I don't know how close y'all are with cash, but definitely now I kind of understand how cash is going out the door. Then I kind of didn't. And so I sort of like look at my bank account of the company in this case. And I'm like, oh my God, I think I need to be fundraising like now. Oh crap. And you just have one of these moments where you realize you're looking death in the face, or the potential of death in the face. I think I've felt that many a time for sure.
Yeah, me too. Me too. And as I was saying, like, I think on one of the last podcasts, what I've tried to do more of is like scenario planning. So don't wait until you get to that, oh shit moment. It's like, you have a few different scenarios that are like, if this happens, then kind of go down this path or whatever.
Yeah.
Also, I think like warming up, I think we actually spoke about this on the chat as well, like trying to talk to a lot more people up front, like whether that be partners or other investors or whoever. I think that was Julian, that came from you, right?
It was advice that was given to me. And it was like, take these conversations that you are going to have in whatever amount of time, whenever your fundraising is intended to occur, and just front load those relationships. Right. And so, for example, I went to Andrew Chen, who is my lead investor at Enders and Horowitz. And I spoke to him and I was like, okay, what's the next round looking like? And chatting about like what that's got to look like in order for us to feel good about it. But the recommendation is, and that's distinct from how I used to fundraise. I used to fundraise like I had a big, very serious attitude of never give investors any data before the fundraise.
I had the same thing before. Yeah.
So what was your reasoning behind it? I'm curious about
that. It was just like a competitor thing. It was like, I was just worried that competitors were going to be able to see this, and try to see what was working and copy it, where like in reality that typically doesn't usually happen.
Yeah.
But it's also on the other side of it. With this company Airhouse, I tried to, like, during our seed round, I like warmed up. So we didn't take any money from any of the major like multi-stage funds. And I did that like on purpose because I didn't want the signaling risk. I had signaling issues before my last company. So I didn't want to do that. So I just talked to a lot of these multi-stage firms. And it's like, this is what I'm up to, but I'm not raising. And to try to build those relationships early, that actually didn't work out the best, but I think like it definitely can. I've now done that for potential partners, potential like acquisitions that we potentially can make. Also, if we ever got in a really tough spot, potential acquirers, getting closer to them, which they may even seem like a little competitive, but it's good to open up those lines of communication. They could be a source for a lot of different things, including capital raises and everything like that. I definitely was like you, Julian, like more closed off to a lot of those conversations, but now it's just like, it's just so fucking hard to build a really good company. And like, I think it's better to be connected to those people. And then you never know what's going to happen. It could change your company's trajectory.
For me, the reason that I never shared data between financings is I, for the longest time, felt that unless there were pressure of someone else taking a deal away from the person I'm speaking to, that they would not do it. And I was just noticing whenever I gave data to a single person, I was just like, deals never get done this way. deals only ever get done when
Yeah.
I speak to one person and then there's somebody else trying to take it away. And so I simply learned as a matter of course. I learned this at between the Series A and the Series B. Series A, I didn't have a process. And this is the other thing that maybe like people listening can take away is running a serious hardcore process that is really thought through. I don't know how much deal pressure and momentum matters in this type of market anymore if everyone is kind of backing out.
Mm-hmm.
But to me, I continue to sit with, well, I will be out in this amount of time, at which point we'll discuss, how the numbers are then. But I will say that there is a lesson that I used to be like one of those people who's like Gary Vaynerchuk, like, we're killing it like all the time. Now I'm like, when speaking to people, I say, here's what I feel we figured out. Here's what I feel we haven't figured out.
Yeah.
Here's what we're working on. And here's what we're proud of. And I think it paints a realist picture from the CEO. And that realist picture is, oh, this person is thinking through the problems.
Right.
Versus this person is just blindly like slamming through walls, but has no idea what's coming up.
Yeah, I agree with that. And I think that definitely attracts a certain type of investor. I think that there definitely is the type of investor who just wants to invest in those hype companies. And so first time entrepreneur doesn't really matter, all those things. But there is, I don't know if you guys listen to 20-Minute VC, but I do, and just to kind of get the investor's perspective. There are a lot of investors out there that do specifically look for traits like this. They look for people who are realistic on things. They look for people that when they say they're going to do something, they come back and they actually like accomplish that. Versus like, everything's great. Like we're this is a rocket ship. Like everything's always great. And like, they try to defend anything that's not working, well, or whatever, versus being like, no, this is a thing that we got to prove out. But like, here's the 4 other things that we've actually done since we last talked that I told you that we were going to do. So I think there's definitely different investor personalities. And I think definitely as like a second time founder, I would definitely lean into that versus we're killing it. As it sounds like you are, Julian. I don't know, Joe, how do you, I know you guys are still seed stage right now, but like, how do you think that through? Do you try to warm up with investors like now, or are you totally closed off? Like, are you thinking, are you just so focused on you're just finding a fit with your product right now? Like, how do you think through that, given this is your 3rd company now?
One thing that has been nice being in Los Angeles is when I was building Klout in San Francisco, it was so easy to like do the coffee catch up with the VC,
Right.
bump into them in the neighborhood. They stop by the office, you see them wherever. And in LA, it's just not, it's just not normal. Like, so I don't, it's nice. And it's funny, I'm in LA and I'm in downtown LA. So most of the LA startups are in the like Silicon Beach, Venice, Santa Monica. So if someone wants to talk to me, I don't go to them. I try to make them come to me as much as possible. It doesn't always work that way, but it, makes them invest a little in the conversation. And when they invest in the conversation, they come to LA, they come across town. I will talk to them about where we are. I'm not doing it as casually as I maybe was before. And again, structurally, LA helps with that. One thing I will talk more about than where we are is where we will be when I raise. Right? So like, I'm just making something up here. If we were talking about revenue, I wouldn't be like, oh, we're at, $500,000 a month in, MRR. I would be, I would talk about it as like, when we hit 1 million, I'm going to be out in market. And that gets them.
Okay.
Like that, I feel like is a nice way to like bookmark where we're like order of magnitude, where we're heading. And they could always do the math on like, well, you're this many people, you raised this many months ago. That means you have this much resume, this much runway. So you must think you're going to get there in this amount of time. Let them kind of figure that out.
Joe, how do you manage? It's maybe a question for the panel, but just how do you manage, Joe, the fact that you just don't know how fast you're going to grow? Like, I was very, I think anyone on my board ever would have said the same thing. They'd be like, this guy doesn't know what numbers he's going to hit. That it's like, it's growing, but he doesn't know why or how. And so, so we would come into a board meeting and be like, we think we're going to hit this. And the consistent lack of hitting, or hitting in some places where we didn't think we would, and then not hitting in places where we did. It was clear the management team, I want to say the word I want to use is inexperienced at forecasting and then hitting targets, which degrades confidence to a degree. And so how do you say, we're going to do A in B amount of time, and then we're going to be at C place when we do that? How can you tell?
Yeah. I mean, way harder month to month, quarter to quarter in the board meeting, I feel like, than in the like,
Right.
here's the vanity metric I know I'm going to like juice to like raise my round. So, I certainly don't feel like I struggle with that for sure. And, in early stage especially, and I've had the false positives where it's like, holy shit, this is going to be huge. And then it's like, oh, falls off a cliff. And, all those different things for sure have happened. And I've had business lines that like, where we we succeed, we're over plan. Like we do better than we even expected. And like the graph gets really solid and we can start doing the prediction, but that's rare. I've not lived many of those days.
I've got another topic to bring up. Like, given the harder fundraising environment, given the kind of macro, even large tech layoffs that we're seeing happen, I just shared a tweet with you guys. DoorDash, which I think is happening with a lot of other larger tech companies, they're reducing the amount that they're paying people. Obviously, there's a lot more people, a lot more engineers or designers, or anybody who's going to work for in a tech company. You could kind of see, like, on the one side, it's harder to raise more capital right now, but that means there's going to be a lot more available employees out there. How do you guys think that this is going to change? Like, I know that I definitely, like, when it was super hot, like we were in the hype cycle at my last company, and like I just tried to do anything I could to keep like engineers happy and like pay them a lot of money, and we had like lunches and snacks and like all of the crazy stuff. So on the other side, if you are a company doing like really well, do you think this is an opportunity to like scoop up some really good talent for reasonable prices? Like we're talking to founders here. Have you guys thought through that at all?
First, Kevin, can you explain how total comp is for those outside of Silicon Valley, where that isn't a topic, the conversational topic at dinners? How is total comp calculated in Silicon Valley companies?
So if you're going to work for like a public company, tech company, they're going to issue you. You're going to have a base salary, which is cash in the bank that you make. And then you're also going to get RSUs that are going to be basically, it's just stock in the stock-based compensation. So there's this one tweet here that DoorDash has reduced, what is it here? The base cash to 180K base with total compensation to be 290K. So that'd mean that they'd be getting 110K in stock-based compensation on top of it, which in a public company, which is one of the reasons you want to go public, people can then go and sell it whenever they want to. But also it doesn't cost the company actual dollars. And we don't have to go into the financials and how that plays out and all those different types of things. But that is the kind of, the definition of like the total comp. And you should also think about this when you're joining a late stage company as well. They're going to do the same thing, but it's not going to be liquid. You're not going to be able to sell your shares. So that's what it is. But the tweet here was just like, for DoorDash to be starting people off, I think this was a mid-level software engineering role with a base of 180. Like, I think I like, maybe guessing like a year ago, that probably would have been double. Maybe.
Yep.
So salaries are coming down across the board.
This is happening everywhere. And I don't think there's any, but the thing is almost every company that wanted to staff up did.
Yes.
And so actually everyone right now is sitting with the old total comp that they had from 2021 or whatever. And we're not seeing a bunch of people that are like, oh my God, great, I can hire, except for maybe like the FANG companies, right? That are going, oh my God, I can hire a bunch of engineers on the cheap now. Like, everyone has the engineers that they want is the challenge, I think. Joe, Andy, are you hiring? I mean, we've stayed at the same size for the past, I want to say 12 months mostly.
We're not hiring today. So we hit our hiring plan in January.
Yeah, we had an idea of hiring, 1 or 2 roles for the year. And right now, those whole ideas are on hold until, we have more confidence, because like, we're just not making those bets. Like, we're certainly being way more conservative.
Yeah, you hire for the positions for the milestones you need to hit, and then you just stay at that steady state. Am I right?
Yeah, that's a great way to do it.
Yeah. But here's another question. Do you think that this, so it has been so employee friendly for such a long time, especially during this boom cycle? Does this change the way that you guys think about like operating your companies at all, as far as maybe some of the perks or maybe some of the people that like you didn't really want to rock the boat? I definitely felt this before at Shyp. It was just like, we were competing with so many other companies and everything that it's like, you don't want to, like, this person is actually underperforming, but it's like, you don't really want to cut them because they're so liked in the company or something like that. And I definitely made those decisions before, but like, do you think that now it has, or it's going to, in the next 6 months, change to more of an employer, friendly environment? And also there's another thing that's happening as well, remote work. I think this is also a big thing that I think that a lot of people saw, employees saw remote work was going to like allow you to move anywhere and keep the same salary. Like, I don't know how much of an impact this is having now. Like, you could now work at anywhere, but also your cost of living are going down. People are hiring less. So now salaries are dropping. So that may also be another thing. I don't know. What are your guys' thoughts on your current team? And how if this would change the way that you would manage them, or
I would just say, like,
anything like that.
My coach, who only coaches, or for the most part coaches Silicon Valley CEOs, actually said, oh, employee activism is a 0% interest rate phenomenon to me, like last week. There was no situation in my company that was related to this, but he brought it up for some reason. I was like, wow, okay, that's a really strong statement, right? And so I don't know, but also I'm not really meaningfully affected by it because only 3 people or something are American in my company. I have people but you don't think it's going to bring down salaries across everywhere, right? Like, it's not going to just be in the US. Yeah, I mean, that's right. But let's imagine that you have we have an engineer in Brazil. Okay. So, and by the way, his name is Rafa and we love him. Okay. So Rafa. And so his comp in 2021 was his comp hasn't changed, by the way, but if you imagine that market is, I don't know, 10 or 20%, are you really considering the delta between your Brazilian engineer and a Silicon Valley engineer, are you really going to like make a change? You're not going to make a change there. You're just going to be like, I have a good engineer from Brazil who's got a market Brazilian salary and it worked, right? It's only at the gigantic extremes of Silicon Valley or New York salaries, and New York is very guilty of this too, that you want to make a change in your company. Joe, I can feel you thinking.
No, I mean, the kind of like, maybe we talked about this before, but shit really rolls downhill. Like the investors are putting pressure on us, with like harder to do financing, like a lot of pressure on terms and valuation. Then founders, CEOs go put pressure on their team, like, hey, there's no salary increases, and we're not doing the bars and the lunch and the this and the that. And that's a reality, and it is a world that's not 0% interest rates, and that's what we live in now.
Well, I think everyone used to like negatively look upon Amazon for having a cheap culture. There's the Amazon in one sphere, and there's Google in one sphere. I've only run Amazons, so my companies don't normally have free lunch. My companies pay very competitively, but we don't have all the bells and whistles and perks. And I'd rather personally pour it onto employee compensation than I would put it on free DoorDash credits and ice cream Tuesdays and Friday happy hours. And I think that's also interesting when the fact that I've run basically 2 distributed companies. So there's some extra costs, but there's also some different costs that you have there. And I think in general, I mean, you don't get points for spending money. You get points for saving money. You get points for the Amazon model. You can go do whatever you want, but the goal of a great CEO, you're a wartime CEO right now, and everyone in a wartime CEO fights the Amazon battle. And in peacetime, you can be like Google. And I think there's a fundamental difference. Why this is all very interesting is we're talking about salaries and how this is all playing out in an environment where there's inflation. And that's a very different environment than any of us have really worked in over the last period. Anyone on this podcast have really never worked in inflationary environments. So, but I'm a wartime CEO and I'll wear that hat and we'll hold the line. And so that's my perspective. Thanks.
I think for me and giving anybody else advice, I think that what should change, and also as an employee of like a startup or in the tech sector, like I think that you should like just do the best you absolutely can. Like I know there's a lot of people that like I'll just speak about like my friends that I see that are super talented and they just kind of coast to their jobs, and it kind of infuriates me. But I think like you as an employee, I think like during this time frame, need to do the best you possibly can, and you will be rewarded for it. But also as a CEO, I think that this, like, get rid of the extra DoorDash credits and all that shit, of course. But I think what this gives you the ability to do is to manage a little more aggressively, on both ends of the spectrum. Like, reward the people who are working their fucking asses off, but the people that were kind of like before in the 0% interest and like the war for talent and everything, you're just like gonna let them coast. It's like, no, they're gonna be on a pip and they're gonna be gone because they're not performing. And so I think that I was kind of I've talked to some of my friends, and I don't think that people really rack their brain around like what it like. They haven't seen their friends that are from Facebook or from Uber or whatever that got laid off, and they haven't been able to find a job in 6 months. That hasn't happened yet, but like that is going to happen. And so I think that for you as a CEO, I think that don't obviously change like things dramatically, but like the reality is there's a lot more talent out there for much
So
more
I don't
reasonable
actually think-
prices.
I don't think that's going to happen personally. Given
You don't
it's a
think
very
so?
tight. No, what you just described doesn't jive with what the labor market is. It's an incredibly tight labor market.
But
I
are
think
you
there is-
hold on? But what labor? You're talking
Oh,
about the
okay.
overall
First of all,
U.S. labor market, right?
Next episode, everyone.
Yeah, we
next
gotta go.
episode.
Okay, that's it.
We
We're
have
out of time.
jobs. Okay.
Yeah,
You
we
may
have to get back to
forget-
work and
What-
in our wartime CEOing.
Right.
So the takeaway from this episode is everybody is a wartime CEO. Do whatever you
Yep.
can.
Yep.
Make that extra email if you need to raise more money.
Don't get high on
this-
your own supply.
Don't get high in your own supply. Do whatever you can to survive this moment in time. Everything hopefully will return to somewhat of a normal state eventually. I don't know what that is. But yeah, I don't know. That's the advice that I would give.
That works for me. Adios.
Thanks
Thanks,
everybody for
everyone.
listening.
Bye,
See you
everybody.
guys. Bye.
Hey, yeah, we keep it real and we bring you the facts. It's the Second Time Founders podcast. Talking tech news, the show is a must. Not some billionaire trying to sell you their book. We coming from a real place, plenty ups and downs. Got some insights, join the discussion now. We being honest and raw, giving you real talk. We've been at the bottom and made it happen and much more. The Second Time Founders podcast. More building, less talk.